All right, well, the jobs number came and went. We had a very predictable initial reaction. The yields fell, the markets rallied because, hey, who doesn't like lower yields? But then the market remembered, hey, there's a reason why yields are falling. And so stocks fell throughout the day. But we ended up with a good finish, and we'll talk about why and what that means going into next week. Next week's a pretty important week. CPI is going to be coming out, so there's a lot of other things. But from a technical perspective, next week is an important week. So I'm going to show you why in today's video and what we're going to be watching for next week in terms of whether or not we're going to start any kind of intermediate decline as soon as next week, or are we going to maintain this bullishness that we've been on for the last so many months? Or are you going to maintain that, again, with a grind higher? So we'll take a look at what we need to, key levels to watch for and what signs and which way I'm leaning and why. And we'll take a look at all of that. Some important intermarket moves, especially with yields. We'll talk about how important yields are to the direction of the market going forward. It might not be what you've heard from other talking heads on TV. So I'll explain myself there. And then our sector rotation was like very, very good. So we had a really good sector, not as good as we wanted. There's one sector in particular that's not up to par. And it's really because of one stock in that sector that we've traded recently in a previous market outlook video. So I'll show you, we'll talk about that. And then we'll look at today's trade idea, which is actually in the same sector as the stock I just mentioned. But we'll look at it for a breakout opportunity of its own. So let's go ahead and get started. Today is Friday, September the 5th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video, comment and on anything that stood out to you today. Join our website at MarketScholars.com for free. You get access to our full Market Outlook blog posts every day. You get it helps you see what happened in the markets today, what matters, why it matters, and what to look for coming up. That's all for free, including our Market Outlook preview. This is the full version of the video that you're getting preview of on Fridays that our foundation members and all of our subscribers at Market Scholars, including our foundation members, get access to. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. And if you're watching our blog or video and if you got to this page, if you get to our Market Outlook page, and you see you want to see the blog post, right? This is the blog post. Like I said, it's a really good job of summing up what happened today and why it matters to you and what to watch for and all that. You get access to this post and the preview video every day for free. When you go to the Market Outlook, just click on, there's a link usually in the YouTube description as well as on Twitter, in the reply to the Market Outlook tweet. So there's also a link in all the social media channels to get to the Market Outlook post. Just click on this button right here to join free. It takes you to the basic page, and all you got to do is sign up. I'm already logged in, so it's not showing the right page there, but that's all. Just your email address is really all it takes to sign up there. Once you are there, again, if you want to watch the full version like you're watching right now, then just hit this upgrade to foundation. It takes you to the foundation page, and you can log in. Again, $29 a month, about $1.40 your video. It's $2.99, so you get 2 months for free if you do the yearly version, which works out to be about $1.20 for video. So really good value considering, again, the value you get out of the trade ideas. You get one trade idea in every video, and we keep track of the results of those trades throughout the year. And the value of those trades have far exceeded the cost of getting them, in addition to any other education services you get here on our website. Okay, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we were down today, but ended up actually not being bad. That move off the lows, at one point in time we had what could be considered a dark cloud cover. Basically a gap after a strong bullish move. You have a gap up higher, and then you close below the midpoint of the bullish body. We kind of got right back to the midpoint. And then at the lows of the day, we had an engulfing pattern where the body completely is outside yesterday's body. And remember, the body, not just the highs and lows, but the bodies, the open and the close. And so We avoided both those bearish reversal patterns with the move off the high. So that's a positive close. Again, we were down 1/3%, but we finished with about as positive as a close you could possibly get. I mean, the momentum line at the lows was at extreme lows. That would have been a really, really bad sign. Even for most of the day, it was at least oversold and giving us a bullish intermediate confirmation signal. Like, that's not the worst sign, but with the near-term line so high, it was unlikely we were to get a bounce off of it. So now we don't have to worry about that. Right now, there's a good chance, like again, here we had a, second day of some weakness that brought the near-term line down, but eventually we bounced. And I think probably a pretty good chance, if not Monday, but by Tuesday, Wednesday, we should be bouncing back up next week. Again, because of how we closed. Had we closed at the lows, I would have had a much different idea of what we would do. But not with how we closed here. That's actually a really good sign for the markets. We actually finished higher on the NASDAQ 100, which is a very good sign. The near-term line stayed in the upper reversal zone. The momentum line fell in the bearish territory, but not oversold. And your intermediate line is, down a little bit, but it's kind of just fluctuating, right, between dark green and light pink. And at least it's still inside of bullish territory above the 60th percentile. So that's a positive, again, for the NASDAQ. Again, figuring that we ended up, we gapped up so much that, the drop today at intraday still ended up staying above yesterday's close. So very good pattern there, considering, again, right? Considering how we started the day. The momentum line was pretty extremely overbought yesterday on the Dow, above the 90th percentile, and it fell today, so it's not surprising. And again, we did not gap up as much on the Dow like we did on the others. And we did fall, but we didn't, it wasn't outside of the range. And the near-term line is actually still moving higher. It's not in the upper reversal zone yet, but at least it's still moving higher. And, you would anticipate a bounce off of this near momentum low point from the Dow Jones going into next week. So again, we really avoided having some bearish short-term patterns on all these indexes. Your Russell 2000 actually was up 0.5% today, so it actually outperformed. It does best in falling yield environments. The Russell does. So you can see the near-term line rallied up into the bullish territory, the upper reversal zone. The momentum line dropped, but did not drop in the bearish territory, only dropped down to neutral levels. They're in between. And, everything's actually still fine. So, like, you would never even know, like, for looking at this chart, that we were threatening a really bearish day today. In fact, we were above average on the range. SPX was well above average on its range today. And yet we didn't falter. And so on some of these other days, like, this one obviously here or this one here that started the decline, I mean, we had a pretty significant above average day and finished at the lows. So the fact that we didn't finish at the lows is a very good sign that leads us into expectations for some bullishness next week from this chart, right? From this chart. Let's take a look at the weekly market forecast. And you can see the near-term line came down out of bullish territory because of the kind of the flat weeks we've been having here. And it's been pretty flat for the past 4 weeks after a bounce up higher off of this near-term low point right here that barely got below the 50th percentile. But we did bounce up, and we're basically still on the same near-term rally, intermediate rally. See, the intermediate declines occur when the near-term line falls into bearish territory. And obviously that has not happened, nor has it even come close to happening. I guess this was the closest here at the beginning of August. This is actually the last week of July, and then that the August 1st was the last day of this week. That was the closest we got, but you can see we rebounded the very next, pretty much on Monday, the very next week, and we rebounded up. We've been rebounding ever since that August 1st low point. Let's take a look at the other weekly charts. Again, a transition candle, but a bullish transition candle, in my opinion. There's an opportunity for us to move higher. We're above 5%. You can see the size of the candle getting smaller. Here's the weekly chart that scares me a little bit going into next week, and that is the whole moving average. You can see, again, transition candles you'd expect. And we are up above, like currently we're trading at 647, so we're above the Heikin-Ashi close, but we are below the 20-week hull at 651. So again, we are, unless we get a really good move to get above this 650 level next week, which I don't expect that we will. If we start to there's a good chance that next week with where the parabolic SAR is and how many weeks now in a row we've been below this 20-week hull, there's a good chance that that leads us into some weakness, and because of how close the parabolic SAR is, and it's just going to get higher next week. How close it is, it makes it likely, because again, an intermediate decline starts when you flip the parabolic SAR to the upside and it turns red, right? That's when it starts there, and so we might not necessarily start the decline next week, but if we flip, it might not turn red next week on the whole moving average, but if we flip that parabolic SAR, then we're probably just a week away. We might get a transition candle next week, but it would be a bearish transition candle. So if we're not necessarily bearish by the end of the week, according to this chart, we could be very, very soon. So this one kind of, as nice as that market forecast looked, it would have been a lot more threatening. This would have been a lot more prescient about what could happen next week. And I don't know if that bounce off the low was enough to change it around. So it's really important that we do not get below today's low point early next week, because if we do, then next week's going to end up being a bearish week. In my mind, it's going to end up being a bearish week, and if it ends up being a bearish week, then we're probably going to end up having our 5% pullback, right? At least a 5% pullback. Again, not all next week, of course, but there'll be ups and downs. But over the course of the next few weeks, we would end up, coming down towards the pre-correction high and the 23% retracement, which would be right around the 5% mark. If you take a look at the 3 green arrow charts, you can see we got 3 green arrows back on the Qs, so the MACD turned positive. It did not turn positive on the spiders. In fact, the stochastics turned back negative, so we're back to 2 reds on the spiders. You have the 1 red on the Dow, so doesn't have the 3 greens, and of course the Russell's has been more bullish, right? It hasn't even, it threatened 1 red arrow. It did get the 1 red arrow over here, and it threatened another 1 red arrow here and never got it. And now it's just moving higher, so that's really good. I mean, it's not good for the Russell to continually outperform the Qs, because that eventually leads to decline. But for a day, it's not so bad, and especially considering the Russell's still catching up, right? It's still doing its catch-up trade to try to catch up to where all the other indexes have already gone. The S&P 500's 2-line chart, you can see, again, as bearish as we were today, we were not going to close below the 17-day. We would have had to go a little bit lower to get below the 17-day moving average, and we ended up above the 8-day. So it's like, you're still above a rising 8-day moving average. How bearish can you be when you're still above a rising 8-day moving average? So, and again, even had we closed at the lows, as bearish as that would have been, because it would have been an engulfing pattern, but it wouldn't have crossed below 2 lines, right? It's crossing below 2 lines that matters the most. And as of right now, again, we're okay. The MACD is still below its moving average. Stochastics is still falling below its moving average. So again, we're not out of the woods. We need to stack some more bullish days next week. But even on this chart, you can see if we were to falter, if we were to falter next week and start, again, more of an intermediate decline, there is so much support down here that it's not going to happen. It's not going to be like a sell-off. It's not going to be this huge move lower, these big gaps. It's going to most likely just be a grind to the downside as we meander our way through this support, this volume, until we reach support, and then most likely get a nice good bounce back up, would be my expectation there. Again, that's if we started that decline here next week. Let's take a look at some of these other oscillators like the DMI. Very positive, above 30 again on the positive indicator. That's a very good sign. We're not quite back below 20 on the negative yet, but we're moving in that direction, so that's positive. And the RSI and CCI are still bullish. We're still above 50 on the RSI, still above 0 on the CCI. We're not above 60 or 100, so we're not strong bullish levels, but at least we're in the upper half of the charts, and that's what matters the most. If you look at the Ichimoku cloud, again, still maintaining a mature trend. We haven't got to 20 yet, but we've been above 15 for quite a while now. We're still above the midpoint of the 9-day range as well as the 26-day range. Rate of change is still clearly positive. The cloud's getting smaller, but at least it's still rising and still green. So we're still good there. And then finally, when you look at the Bollinger Bands, we are in the upper quartile 2 days in a row. The bandwidth is really falling. So we're only, right now, the low point here is 2.37. This is the size of the bandwidth. That's the 150-day low size of the bandwidth. And right now, the size of the bandwidth is 2.44. So we are very, very close to a squeeze. And the last squeeze didn't work out so well for us, right? We ended up, getting above the upper band first, but then really breaking out to the downside. So we're not, obviously we're not above the Keltner channels. The bands themselves are inside the Keltner channels. Again, very similar to what we saw there going into that pullback. So another sign that we are setting ourselves up for a pullback, whether, again, starts next week or not, or the week after, that remains to be seen. But we are definitely setting ourselves up for, again, just a minor, most likely just a minor little exhale and nothing more than that. If I take a look at the today's intraday chart, we did get a new high today, so we gapped up with the initial response to the jobs numbers and falling yields. We gapped up to the upside, so we got a new high. So again, we reset the clock for 6 days. But I told you the low point moved up to here, and so that's what you see here. So we did jump up to 42. Again, that in the past has there's been some weakness that comes after it, but then we bounce back up. So I don't know how long that weakness may last. Over here, we got it. We got that bump up, and it got up to 100. But that was the failure, right? That was the squeeze play that failed to the upside and then turned around. So we do need to be aware of that happening, even though the past 3 instances have all been relatively bullish after some initial brief and very shallow weakness. If I take a look at the trading range and volume, you can see the range was well above the average. The volume was also well above the average. So both those numbers actually brought their averages up. The normalized ATR is almost back up to 0.9. But remember, this is the sweet spot here. You're not above 1, which is not bad. It's getting above, getting up to 1.25 is when you, or 1.5 is when you really have to start to worry. But we're not above even 1 yet. And we're also not below 0.8 anymore either. So both those instances are kind of worrisome levels. We're kind of in a little bit of a sweet spot. So I like that. The volume is still pretty high, but remember, it's the money flow that matters here. And look at that. We're back into the upper half of the chart. The money flow itself fell because we were down today. It fell there, but again, we need to see a better picture here. We need to see this index jump up into bullish levels again so we can maintain the bullishness and not form another lower high point and roll over to, if we do get a lower low, it would be in bearish territory at that point. All right, let's take a look at the VIX. Of course, the VIX jumped early today, jumped up here to just above 16, but then we fell back down and almost closed below 15. So really good week of volatility. Started higher as usual, but then we fell. We fell all week long from 19 down to 15, and we fell and almost closed back to 80% again, or 0.8% again relative to the VIX 3M, and the VVIX fell again. Like, it didn't fall a lot, still above 90, but at least it's closer to 90 than it is to 100. So it's moving in the right direction, and the correlation is back to 97% between the VIX and the VVIX. So we're back to good levels. The VIX, of course, as I showed you yesterday, is back below its average values. So we are back to good levels on the VIX. And so again, a good chance that we go into next week relatively positive. We do need to be aware of the potential for a bearish week, though. So again, it's going to be, it's really going to be a factor of whether we ever trade below today's low point. We've set the low with this big move. We bounced off of it and closed near the highs of the afternoon. So whether if we break that low we set today, early next week, then we're probably going to be due for, again, not a 5% down week in 1 week. I mean, it might only be down 1% for all we know, but it probably would end up being a down week and that could be the precursor and the starting point for, again, that just normal, very, very normal 5% exhale that would ultimately lead to a really, really good bounce to the upside. So I am not worried about that kind of drop in the least bit. As much as nobody wants it and I don't want it, but when it does come, then great. Then we'll be able to make some really good directional trade opportunities. We'll be able to make some directional trades and take advantage of what the next green tag could be on that zigzag chart, which most likely would be in the double-digit range. All right, now let's take a look at what's driving this price action. You can see over the last 3 months, small caps have but they really took off here lately. Really since, what would this be? August 21st, right? Since starting on August 22nd, which would be last Friday, so 2 weeks ago. So this would be, 10 days because of the Labor Day holiday. 10 trading sessions. The S&P is up 2%. The Q is up just a little bit more, 2.25, and more than double, almost double. IWM, more than double the S&P. So really good move. The dollar's been weak. Yields have been down, and that's really what's been helping. And that was the case today, right? Yields were down considerably today, coming after the jobs number. The jobs number coming in at 22 million, but when you count, again, revisions, there was more revisions lower than what we gained. So the June number was revised for its second time. It actually was revised to a negative number. So we actually had our first negative print for a while. We saw earlier in the week the job openings was less than the number of employed persons looking for a job. So you have some milestones with this current job situation, and so the interest rate cut odds jumped and bonds fell. Look at TLT up 1.5%. Look at this move here on this chart on TLT. So big jump higher. I mean, look at that, like dark, light green shading, but a green line on the market forecast after getting these bull tags. The intermediate line still hasn't, the near-term line crossed the intermediate line. We talked about that, but the intermediate line still hasn't crossed market sentiment yet or above the chart's midpoint. That's most likely going to happen tomorrow or Monday. But very strong near-term rally, getting up to 98.8. I mean, that's, again, one of the stronger near-term runs that we've seen here for a while. Breaking above these prior highs here, on both those prior highs. So good sign for your TLT, which means this is not quite the 10-year yield because IEF is more to the 10-year yield. But look at that drop in the 10-year yield, down to 4.1%, getting another cluster. So we've got 3 clusters in the last 6 trading sessions. Intermediate lines way down. Both short-term sentiment lines stayed down for another day. They're both at extreme lows. So we're really set up. So again, last time we bounced off of these lows, we had a pretty good rally on equities. So there's a good chance that that we rally here. The market actually did okay after the bond market closed this afternoon. And so again, we'll see what ends up happening on Monday. But my expectation is yields will probably end up bouncing on Monday, coming back up towards 4.25%. Maybe not quite above it, but at least getting back up towards it. Back up towards that moving average. And that would be bullish. In my opinion, that would be bullish for equities. Because if we break 4% next week, then that's our worst case scenario. Because again, the last thing we want to see is yields dropping across the board here. Let's see, let me pull this one up. And you can see the yields. Like, we do not want to see the yield curve, everything dropping, right? Starting with the 30-year and down here, and the short-term rates falling because the Fed rate cut expectations are increasing. In fact, the rate cut odds jumped up to a really, really high number here. Let's take a look at this chart, this page. And obviously we have 100, in fact, the odds for a 50 basis point cut jumped today. And I don't think we'll get 50 basis points. But you can see it jumped up. At one point in time, it was at 12%, finishing only at 8%, but still 100% odds of a cut in September. This is what really stood out, was now we have an 80, 78%, 70, almost 79% chance of a cut. And that was in the 90s this morning too. So we have a 70, almost an 80% chance of a cut, another cut in October. And of course, very high probability that we get a cut in December as well. You can see very high probability, 98%. So the question is whether or not we get a series of cuts that go through the beginning of next year into March, because the high, again, for 3 cuts by March, we're looking at 95%. So are we going to get a series of cuts between now and then, which would be our worst case scenario? Or are we going to get like maybe this one cut and then maybe a second one in December, which would be our best case scenario? I'm leaning towards the former rather than the latter. And so as a result, that probably means that yields will probably be bottoming out here and start working their way higher. And like I said, that might not be great for small cap stocks, but I think a lot of your mega cap names would rally on that, on rising yields. Again, not back up to like 4.5%, but back up towards at least that 4.25. So we're not getting a big breakdown. Like I said, if we keep getting a big breakdown here, I think that's our worst case scenario. And now we're looking at, potentially like not just a 5% drop here, but what could be a 10% drop on this pullback, down to the 38% Fibonacci level on that zigzag chart. And now we're looking at a double dip correction, like a back-to-back correction here within, a 6-month period. And that's, that would not be a good sign for the market in the least bit. So we'll see. I know that everybody says they want the rates to fall, but we really don't. Like, again, when all these rates fall, as we saw here and here, stocks generally do poorly. So we don't want that. We want rates to just stay steady, like sideways here, and go back up a little bit. That's what we want. We want the yield spread to stay low, closer to zero, fall, and get closer to zero, because that's where stocks rally. Stocks don't rally when the yield spread rises, right? We don't want it to rise. We want it to fall. So that's the main driver. Of course, you also have, issues like the dollar. And you can see the dollar was down today. That actually helps. If the dollar continues to go down, that would be a helpful thing. And commodities were down as well, and that would not be helpful if commodities were to continue. It's one thing for them to be lower. So we had, the three-headed monster, but in our favor, as commodities, the dollar, and yields all fell. But again, commodities is also a reflection of economic growth expectations, and we don't really want a bearish move in commodities, because that, as we saw earlier in the year, is typically bearish for equities, not necessarily bullish. The breadth actually turned out to be relatively good today, back up to 24, so stayed positive. We're back above 500 on the summation index. That's a positive development. And the really good positive things came from these other breadth indicators that we like to look at, including the number of stocks above their 50-day moving average and number of new highs we're getting, right? Those are all very positive developments. So let's take a look at those. Here we go. We'll start off with the number of stocks above the 50-day, jumping back above 300. Of course, the number of stocks above the 200-day still staying above 300. So that's good. The number of new highs jumping up to 198. And let's see, I'm pretty sure that's legit, but let's take a look at that. This is 108, 201, yeah. So that's pretty legit. Very few new lows. That's a good sign. So really, really good sign there. Of course, that means a net new highs and lows jumping up to a high level as well. And then the number of stocks showing bullish patterns on their point and figure, still below 60%, but not falling anymore, right? We jumped up a little bit of a pullback the last couple of days, but not, not breaking down. So I really like, even though the, sentiment's not necessarily bullish, right? That's that if there's another sign that we could be headed towards a double dip correction, this would be the other one. Both the bullish sentiment and bearish sentiment are both below the historical averages. And that's generally, especially considering how bullish we've been, and for us to still have that issue, we've gone through these old highs. For us to still have that issue, it's pretty similar to how we ended 2021. So we don't want that, right? We don't want to see weakness there, and we are seeing weakness. And so, that's one sign. You can see some of these other surveys aren't looking so hot either. If there's any, sentiment's not looking positive, breadth looks better, but we really need a rebound in that sentiment if we're going to rebound, and kind of maintain. Again, we're not rebounding because we never did fall, but maintain this strong bullish trend that we have. The other thing that's not necessarily the most bullish today was the sector comparison chart. Let's take a look at that here. Let's go. Semiconductors actually did pretty well, aside from NVIDIA, of course. You can see technology stocks outperformed the markets, but did not outperform real estate, and staples, and healthcare, and materials, right? They all outperformed. And I mean, yes, those three did better. The technology, discretionary, communication services, all outperforming the markets, and really your two biggest losers were your financial stocks and your energy stocks. Really, really big losers on both of those. Let's zoom out to the week that was. And you can see it wasn't necessarily our best week, but we did have communication services up 3%, discretionary up 1.5%. Technology was up, lagging the markets, but up and outpacing everything else, right? Including financials, industrials, energy down 3.3%. So this was really good for the week to see energy or technology outpacing energy by that much. That's a much better than how we finished last week. If you remember last week, XLK had broken down versus energy. You can see broken below the 50-day. We were not looking very good there. But now look at that. Big time rebound. After opening the week poorly, big rebound in technology relative to energy. That's exactly where we want to be. The RSI is moving higher. PPO is starting to move higher. The CC, I mean, everything's looking much better. So that's the ratio we want to see moving. Of course, the other one would be like discretionary relative to staples. Don't know why that happened. Let's try that again. This discretionary relative to staples still looking really good. Still above all the moving averages, still all rising. Everything's positive, 89% correlation. So that's a very good sign for the markets to see that ratio, both of these ratios working in the right direction. So not the greatest week, but at least a positive sign. Again, going into next week, a positive sign there. A little bit of weakness in technology that we don't like to see. So a little yellow flag, not necessarily a red flag there, but a little bit of a yellow flag. And we'll see how that, you'll see if that rectifies itself. But lately, when we've had weeks where technology has not done what we wanted, it usually backs it up the next week and gets going again. So we'll know really quickly Monday, Tuesday of next week if technology is doing what we need it to do, including, you know, a really, really important bellwether that we have a bearish trade on from a previous market outlook was NVIDIA. And NVIDIA is down 2.7% today, like, and breaking below. It already has broken below averages, and the 8 and 17 day have crossed the 30, and MACD and stochastics are clearly bearish. So this is the problem, right? So this needs to have some recovery next week for technology and thus the market to also still maintain bullishness. If this continues to move lower, it's going to be really hard for technology and then the markets not to move lower along with it. So it's such a big bellwether. So really important week for NVIDIA next week, and not a good finish to the week this week. Again, might be another, this is a red flag. It might be another kind of sign that next week might be, you know, again, our first bearish week of what may be a kind of very easy and normal intermediate decline here. Okay, so that actually takes us to our trade idea of the day, excuse me. And for those of you who watch the previews, this would be your one trade idea for the week. Remember, all of our foundation members, tier members, they get every trade idea, all 5 of them, throughout the week. So here's the one for the week here. It's on TSM. It's in the technology section, semiconductor name, obviously. But unlike NVIDIA, rallied today really nicely. Near-term line jumping well above the 90th percentile for the second time, higher highs. Intermediate line turning back up out of bearish territory. Market sentiment's falling. We're still below it, but again, moving in the right direction there after, you know, this intermediate decline here. You can see from a crossover standpoint, our weekly standpoint, we had a transition candle, but a very strong bullish candle. So very good opportunity for a bullish candle next week, as we're trading currently about $10 above the Heikin-Ashi close. You can see the size of the candle turning back up above its moving average. The PPO is already relatively strong, but only in the 76th percentile, so opportunity to grow. When you look at the 3 green arrow chart, you see the stock has 3 green arrows today with a good amount of volume and already has a green line. So very strong move from that perspective. Looking at the 2-line version of this chart, we're back above all these moving averages. So that's a good little breakout move as well. If I take a look at the the other oscillators, let's take a look at some of these other oscillators here. The DMI, we're above 35 on the negative indicator, but almost below 25. So you have to keep in mind that there's a higher scale here. So just getting below 25 is very good on the negative indicator, and getting above 35 is like getting above 30. So we're really close to being pretty, having a pretty good pattern. Your ADX is really low, so it's setting itself up for a breakout type move. The RSI and the CCI are also at bullish levels. Flirting with 60 on the RSI, and well above, easily above 100, not above 150, but easily above 100 on the CCI. If you look at the Ichimoku cloud, again, we had a bullish trend, we lost it, stopped at the cloud, and now have bounced back up, well above the green and blue lines. The rate of change is slightly positive, and we don't even have a weak bullish trend yet, so we might just be getting started here. And then when I look at the Bollinger Bands and the Keltner channels, we are in the upper quartile of the bandwidth. The bandwidth had broken down, so we broke below, like we were going to break down, but we might have been a fake out, and now we're moving up, and you can see the momentum is turning higher. So we have an opportunity to really get bullish here on Taiwan Semiconductor and start moving to the upside. So what I decided to do was come out here to the 30 delta and sell that 260 strike, buy the 250. If you take a look at that here on the Analyze tab, we didn't position size the 500 because if I did a second contract, I would have had $700 of risk, and we like to keep it to 500. So, but we did get nearly a 2-to-1 reward to risk ratio, so almost up to $700 of reward for that 350. So, relatively high probability trade because the reward to risk isn't that high, but a good opportunity here to get a good return with very, very low risk. Again, 2-to-1, but if I were to cut this off at $150 loss, and that's more like a 4-to-1 reward to risk ratio. So really working out in our favor if we continue this bounce into the, you can see, like when you look at it from a 4-week range, TSM, let's move it here. And you look at the 4-week range, that's a nice, good breakout into the upper reversal zone. So really, really good opportunity for the stock to get going. Just like we saw with our trade idea yesterday in the communication services sector. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Scroll to the bottom of the page, comment on anything that stood out to you today, or if you had any questions about what I brought up, or if you have questions about something I didn't bring up, post those down in the comment section. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel, hit that thumbs up icon, comment, and share the video with anybody else that you think would be interested in it. Follow me on Twitter at DavidSettle42 for more content between the videos, and follow me on LinkedIn and Facebook as well. All the social media sites, like our content on those sites. Have a great rest of your weekend, everybody, and we'll see you all on Monday.